3,600 stock trades in under 3 months by a sitting president of the United States. That is not a typo. Between January 6th and March 30th of 2026, Donald Trump's portfolio made about 3,600 trades, buying, selling, buying again across more than 1,000 different companies and funds. And the names at the very top of that buying list, among them Netflix, Amazon, and Microsoft. The biggest tech companies on the planet. Now here is the part that should make your ears perk up. This week, those exact same big tech names just cracked. The Nasdaq fell hard. Microsoft and Meta dropped into bear market territory. Nvidia got hammered, and a wave of money started asking one quiet, nervous question. Is the whole AI boom built on hope? So today we are connecting two stories that the headlines keep treating as separate. The president trading like a Wall Street day desk, and the big tech sell-off rattling your retirement account right now. Because when you put them side by side, there is a lesson in here that can genuinely protect your money. Stick with me because there is one move most people get completely backwards when news like this hits, and I will get to it. Quick note before we dig in. This is Sarah Finance, and we do this every single day, so subscribe if you want to keep up. And remember, this is not financial advice and for education only. Okay, let's talk about that disclosure. The president personally signed a 113-page document listing every single one of these trades. 113 pages. When you actually dig into the numbers, you get 2,346 buys and 1,296 sells. The total value lands somewhere between $212 million and $695 million because these filings report wide ranges rather than exact figures. Technology was the biggest sector by far, then exchange-traded funds, then industrials. His most active names, Microsoft, Amazon, Meta, Netflix, Oracle, and AMD, each got traded somewhere between 17 and 22 times. And March was wild. Earlier in the year, his portfolio averaged around 400 purchases a month. In March alone, there were about 1,565 buys. On one single day, March 23rd, the account made 283 buys and 17 sells in a day. One investment professional who looked at all this said he had never seen a strategy that would warrant that amount of trading. Think about that. Trading is his whole career, and even he was scratching his head. Others were calmer about it. They read the pattern as tax loss harvesting, basically selling your losers to lock in a paper loss that lowers your tax bill, combined with broad indexing, which is just owning a little of everything. Both of those are normal, boring, perfectly legal tactics that millions of regular investors use. So the activity by itself is not the scandal. But here is what is not up for debate. A sitting president running an active, high-volume portfolio across the very companies his own decisions affect is something we have simply never seen before. Past presidents tended to park their money in blind trusts or plain index funds precisely so nobody could ever ask this question. This is a different approach, out in the open 3,600 times over. And that is where it gets uncomfortable. Because some of these trades line up with policy in ways that are hard to ignore. Let's start with Nvidia. On January 6th, the managers running the portfolio bought between $500,000 and $1 million of Nvidia stock. The very next week, the administration loosened export controls so Nvidia could sell more of its AI chips to China. Nvidia stock went up. The buy came first. The favorable policy came right after. Now Dell. On February 10th, the portfolio bought $1 to $5 million of Dell when it was trading around $120 a share. 9 days later, on February 19th, Trump stood in front of a crowd in Rome, Georgia, and told them to go out and buy a Dell computer, out loud, to a crowd. After the Pentagon later handed Dell a $1.4 billion Air Force contract, Dell took off. Today it trades around $409 a share. That is up roughly 228% this year. Then Palantir. On April 10th, Trump praised Palantir's warfighting technology on Truth Social. At that moment, the stock was sitting near an April low, around $122. Since then, it has rebounded about 33%. So that is 3 different names, 3 different stories, and the same uncomfortable shape every time. A move from the president and a stock that benefits. Now I want to be fair here because the truth matters more than the outrage. We do not have proof that any of this was illegal. The defense is that an outside manager runs the account, not the president personally. But you can hold 2 ideas at once. The trades may have been handled by a manager, and it still looks strange for the person setting the policy to be on the other side of the trade. That tension is exactly why this blew up in Washington. Which brings us to the showdown. On June 3rd, a Senate hearing, Senator Elizabeth Warren went straight at Treasury Secretary Scott Bessent. She asked point blank whether the SEC should be knocking on President Trump's door. She called for an investigation into possible insider trading. Bessent pushed right back. He said the president is not sitting in the Oval Office doing high-frequency trading, and he pointed out clearly the president had an outside manager. No charges, no investigation announced, just a very public fight over a very simple question. When the person making the rules is also playing the game, who is watching? And here is the detail that surprises almost everyone. Right now, there is no law in force that bans members of Congress or a sitting president from trading individual stocks. People assume there must be a rule against this. There have been proposals, hearings, plenty of angry speeches, but no actual ban has made it into law. Ethics experts have been raising their hands about it for years, from both sides of the aisle. Nothing has changed. So technically, none of this breaks a rule, because the rule does not exist yet. That is its own kind of wild. So hold that thought, because now we have to talk about why your tech stocks just took a beating this week. And later I'm going to show you the one move that separates people who build wealth through weeks like this from people who panic and lose. Keep that in the back of your mind. Here is what actually happened. On Tuesday, June 23rd, the Nasdaq fell 2.2%. That is about 580 points in one day, closing around 25,587. The S&P 500 dropped 1.4%. The Dow basically shrugged and stayed flat. And this was not a one-day blip. By Friday, June 26th, the Nasdaq had logged its fifth straight down day. The damage was concentrated right where the president had been buying. On that Tuesday, Nvidia fell 4.2%. Broadcom dropped 3.1%. Alphabet slipped 0.8%. Amazon actually nudged up 0.6%, the one bright spot, but the scary headline was this. Meta and Microsoft fell into bear market territory, meaning down more than 20% from their recent peaks. So what cracked? It was not one thing. It was a pile of worries hitting at once. The big one is doubt about AI itself. Not whether AI is real, whether it will earn the enormous profits its stock prices already assume. For 2 years, investors have been paying premium prices on the bet that AI would print money, and lots of it, very soon. Traders even have a word for it. They started calling these valuations frothy, which is a polite way of saying the prices have run way ahead of the actual earnings. And then a stat went around that stopped people cold. At Bank of America, only about 3% of customers actually pay for AI services. 3%. That is a real number from a real bank with millions of customers, and it punched a hole in the story. Because if the companies building all this AI are spending fortunes to do it, but the people who are supposed to buy it are barely paying for it yet, then the math gets a lot harder to justify. That is the doubt that spread across the market this week. On top of that, there were reports that OpenAI might delay its public offering to next year. Data center costs for running all this AI keep climbing, and there is fresh worry that the Federal Reserve could raise interest rates later this year, which tends to hurt expensive growth stocks the most. Now zoom out for a second, because this part really matters. Since the November 2024 election, the S&P 500 is still up about 30% as of late June. Put that next to all the scary headlines. Up about 30%. It had recently hit records above 7,000. So no, this is not a crash. This is a hot market catching its breath after a huge run. But it is a reminder of something a lot of people forget when times are good. The same handful of giant tech names that carried everybody up are also the ones that can drag everybody down. When a small group of stocks makes up a huge chunk of the whole market, your gains get supercharged on the way up, and your losses get supercharged on the way down. That is what concentration does. It cuts both ways. And this week, for the first time in a while, a lot of people felt the other edge of it. If your retirement account leaned heavy on those same few names, you felt this week more than someone who owned the whole market did. That difference is not luck, it is design. And just when big tech needed a calm week, it got one more curveball. On Friday, June 26th, Trump went on Truth Social and threatened an immediate 100% tariff on any country that puts a digital services tax on American tech companies. He said it would supersede existing trade deals. This is aimed mostly at European taxes on US big tech, and it comes on top of something from earlier this year. Back in January, he had already slapped 25% tariffs on advanced chips, including Nvidia's H200 and AMD's chips, with some carve-outs for companies building up supply chains here at home. So picture the squeeze. Tech stocks are already wobbling on AI doubts, investors are nervous about interest rates, and now there is fresh tariff uncertainty layered right on top, hitting the chips and the software giants from a whole new direction. When you stack three worries on the same handful of stocks in the same week, you get exactly what we got. 5 red days in a row. No wonder it has been rough. Okay, I promised you the one move people get backwards, and here it is. When a story like this breaks, the instinct is to copy the smart money. The president is buying Dell and Nvidia, so I should buy Dell and Nvidia, right? Here is the trap. You only ever see a politician's trades after they are filed, after the move already happened. By the time that 113-page disclosure is public, Dell has already run up 228%. You are not front-running the president's calendar. You are showing up to the party after the good music stopped, buying at the top, chasing a gain that already left. That is the backwards move, reacting to old news as if it were a fresh tip. And it is exactly how regular people get hurt, buying the hype right at the top, right before it cools. The Dell story is the perfect warning. If you had seen that disclosure and rushed in to copy it, you would have been buying after a 228% run, hoping it had a second act. Maybe it does. But you would be betting on the riskiest part of the ride, not the easy part the early buyers already enjoyed. So what actually works? Let me give you the calm version. The stuff that has built more wealth than any hot tip ever has. First, own the whole market instead of betting on a few names. A low-cost index fund holds Microsoft and Amazon and Nvidia and hundreds of other companies all at once in one simple purchase. When one giant cracks, like Meta and Microsoft did this week, the others cushion you. You are not wiped out by any single bad story. And just as important, you stop needing to guess which company the president mentions next, or which AI stock is the real winner. You just own all of them and let the market sort it out. That one decision quietly removes most of the stress from investing. Second, dollar cost average through the scary weeks. That means investing a fixed amount on a regular schedule, no matter what the headlines scream. Same dollars every month, market up or market down. Weeks like this one, when everything is red and the Nasdaq is on its 5th straight down day, are exactly when steady buyers quietly load up at lower prices. The panic sellers, the ones reacting to the scary headline, are the ones handing them the discount. You want to be on the buying side of that trade, calmly and automatically. Third, do not bet everything on AI hype. AI is probably going to be huge, but huge for the technology does not automatically mean huge for every stock at today's price. Let it be a slice of your portfolio, not the whole thing. Fourth, keep a cash cushion. When you have a few months of expenses set aside in plain savings, a red week is just noise on a screen. You are never forced to sell your investments at the bottom just to cover a surprise car repair or a medical bill. That is how a lot of people lock in losses, by being forced to sell at the worst possible moment. Cash is the thing that keeps that from ever happening to you. It is boring, it earns a little interest, and it buys you the one thing the panic sellers do not have, which is patience. And fifth, judge companies by profits, not posts. We literally watched it happen this year. Palantir got a shout out on social media and the stock jumped. Dell got a verbal endorsement at a rally and it became a headline. But a stock that pops because of a post can give that pop right back just as fast, because nothing about the actual business changed. Real lasting returns come from companies that genuinely make money quarter after quarter, year after year, whether or not anyone is talking about them online. The quiet compounder beats the loud headline almost every time. Here is the thread that ties this whole thing together. The president made 3,600 trades and the headlines went wild. Big tech cracked this week and the headlines went wild again. But you do not build wealth by reacting to either one. You build it by owning the whole market, buying steadily through the noise and refusing to chase whatever just ran up. Time in the market beats timing the president. Every single time. The boring plan is the one that wins. And the best part, once it is set up, it works whether the market is hitting records above 7,000 or having its 5th red day in a row. You get to stop refreshing the headlines and start living your life, knowing your money is doing its job in the background. So that is the real story behind 3,600 trades and a cracking tech market. 2 loud headlines, and 1 quiet strategy that beats them both. If this helped you see through the noise, do me a favor and subscribe. We break down the money news that actually matters every single day, and I would love to have you here for the next one. Take care of your money, and it will take care of you.